Evening, everyone. Good evening, Arpit Bhai. It's as we all know, this is our last session of this wonderful, seminar on Fema. And we have a very wonderful and fabulous speaker with us today, Arpit Bhai. So before starting, let's keep our hand on our heart, and we'll start with our institute motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Good evening, everyone. So, as we all know, it's the last session for today, and we have Harit Bhai also with us. So, I'll request Harit Bhai to have a few words with us today.
Thank you, Arpit Bhai. Very, very respected C. Arpit Jain. Sir, we were so missing this lecture. We wanted to do it. Even, we wanted to catch hold of you, sir. And I'm sure members would be watching it live, and they also would be watching the recording, because all your sessions have always been so fantastic. And all the participants for this Fema series, I think, yes, today, there are less participants who have joined in, but I'm sure this entire series has been a great value add for all of us. And obviously, today's recording will be shared. But Arpit Bhai, thank you to you and all the faculties for making it so special for us and for sparing your valuable time in spite of your busy schedules. And I think all the recordings have already been put up on the Ahmedabad branch YouTube channel. So there are members who are asking us for the link. So now you can directly go to the Ahmedabad branch channel, and you will see all the recording day-wise. So that is available now. And with this, I will not take much of the time. Over to you, Hardik Bhai. And thank you, Arpit Bhai, for joining in today.
Thank you, Darit. Thank you very much. Honestly, I would say that unfortunately, last I think 2 times, somehow this session was scheduled rather different topic. The first, because of election, I couldn't take it, and second time it was COVID. So I must say that both of those things were beyond my control. Somehow this has got delayed significantly. Series is almost over, and probably this pending item, I am fully, I can fully understand as to the lesser number of people, because now I think the tempo which was set up at that point in time, probably it has gone down a bit. But let's
I think,
go ahead with whatever it is.
Yes, absolutely. Yes, thank you.
Yeah.
Yes, sir. But it's really privileged to have you with us, sir. So I'll take this chance or opportunity to introduce you to all of us, our participants today. So it's really my privilege, and I'm honored to do this. So regarding Sri Arpit Jain, all of us know him. But just I'll like to speak something about few of his achievements. Professionally, Arpit Bhai is a partner with KC Mehta and Company. He leads the international tax and transfer pricing practice, and is also in overall charge of Ahmedabad office of the firm. He has been involved in advising a number of MNCs on on matters relating to international tax and transfer pricing. He specializes in tax and regulatory implications of cross-border transactions, covering exchange control regulations, tax treaties, and transfer pricing. He is also involved in advising Indian corporations on various domestic taxation issues. He has professional experience of about 20 years, including 13 years with KC Mehta and Company. Prior to joining KC Mehta and Company, he was working with Deloitte Haskins and Sales for about 6 years. He has been named as a leading transfer pricing professional in India in TP World 2014 by International Tax Review. He has co-authored India report on the subject of the notion of tax and the elimination of international double tax or double non-taxation for International Fiscal Association, published in KHEADS 2016. He has been a regular faculty on intensive certificate course on international tax conducted by Institute. Regarding his awards, recognitions, and achievements, he was on chair of International Tax Committee worldwide of BKR International for from 2020 to 2022. Is leading transfer pricing professional in India in TP 2014 by International Tax Reviewer. Awarded Best in Class award by Deloitte for research on the issue of restricting dividend distribution tax, evoking Article 10 of Tax Treaty. He has secured 4th rank in India in CA final examination. Now, regarding a few publications and articles where he contributed, in India report on the notion of tax and elimination of international double taxation or double non-taxation for publication in KHEADS 2016. Research paper on transfer pricing flip side compliances for International Tax Conference organized by Chamber of Tax Consultants. Article on case studies, domestic tax considering GAR for the Chamber of Tax Consultants. Article on secondary adjustment, the untold story in Tax Sutra. Contributed article on Indian CFC regulations and analysis from international perspective. It was the International Taxation Journal of Taxmen. Along with this, he has also written article on foreign tax credit in India in CAA Journal. As we know, he's a fellow member of our institute. Bachelor of Commerce, he did it from Maharaja Shayaji Rao University at Baroda. He's also a member of International Fiscal Association. So it's we are really honored to have you, Arpit Bhai, with us today during this session. And though there's been a few to and fro for your sessions, but it's really, we are really honored to have you together. And I'll just now, without taking much of time, hand over the platform to you so that we can gain from your wisdom on today's topic. Thank you, sir. Please.
So Hardik, thank you very much for those kind words. Probably they were more than what I really deserve. But
so as I said initially, these are those few achievements that you have procured, sir.
So I think. So I think Hardik, thank you. I think today's session is scheduled on an Q&A type of module basically, and because I think FDI as well as ODI has been already covered by these earlier experts, and therefore when it was a residual session, which honestly then we discussed that we can have it on a Q&A mode, where the questions relating to FDI or ODI is what can be posed by the participants, and then probably I would to the best of my abilities I would try to respond to them. So you can probably also either put it in the chat box, or you can raise your hands and probably ask the question, and we can start the discussion probably.
Definitely, that's right, sir.
Request all the other participants to either put your questions in a chat box or ask us, then we can unmute you and you can directly ask the questions to the faculty.
Along with that, Arpit, we can also gain some clarity on few of the frequently asked questions that you may have come through your professional expertise that the clients are facing, the common issues. We can have some discussion, or you can share your experience on that for a few minutes. Meanwhile, we can have some questions from participants.
No, I appreciate honestly, precisely for that reason, I did not prepare any sort of pointers or those things for me. So I can throw some random thoughts. May be relevant, may not be relevant, because I think by the time someone puts up their question, uh, uh, in fact, I had suggested probably that in case we can ask participants to put up their questions yesterday
Yes,
only.
sir. We have first question from Mr. Aniket that FEMA NDI rules 2019 has given certain rules regarding the acquisition of immobile property.
Yes.
There are also acquired and transfer of immobile property regulations 2018. Which one should we refer?
So, see, typically, 2019 onwards, effectively, it would be FEMA non-debt instrument regulation 2019 only that would be applicable, not that 2018. Effectively, it replaces all the earlier regulations dealing with those topics, which are covered by non-debt regulation. In 2019, they came up with non-debt as well as debt regulations. See, originally, we had so typically it was an FDI related regulation, but over a period, what an FDI related regulation was supposed to typically cover equity basically, but over a period, they found it a bit relevant to define what is debt, something which is payable with some sort of a mature with some sort of an assured kind of a thing, and all other things were considered as a non-debt. In fact, there was a guiding principle which said that for an equity instrument or a non-debt instrument, one of the basic requirement would be there would be an assured return. Even the exit clause, wherever permitted beyond the period of lock-in of 1 year or probably more in case sectoral cap requires. So the basic guiding factor was immobile property has been also defined as one of the non-debt instruments. So immobile property, while typically what we understand is immobile property is not an instrument, it has been covered as part of a non-debt instrument, and that will be governed by non-debt instrument 2019 only. So 2018, sorry. So that 2019 circular would only regulations would only be applicable. Amit Kothari has a question. Can an individual invest into company outside India through LRS, which already has a subsidiary in India, or it will be considered as a round tripping? Amit, I think when we are looking at an investing by an individual, Indian resident individual under an LRS, I think there are a couple of restrictions where first, which is let me come to your question and then probably slightly a different answer also to that. Round tripping, if you ask me, round tripping is nowhere mentioned in any of the FEMA regulations. However, by virtue of the practice, it is considered that this is not permissible. And in case you want to enter into any transactions which would effectively end up in Indian money going out and probably returning back, that would be treated as a round tripping. Question is whether an existing entity having an existing entity outside India and having an investment in India, if you are subsequently investing into that entity, whether that would amount to a round tripping. Let me put a question, because that has never been defined. But in a practical sense, more or less, I think the RBI authorities do consider that as a round tripping. We don't have much of a clarity except for an FAQ which was issued by RBI, and which had said that round tripping would need a prior approval of an RBI. Even that doesn't define it to a great extent. I can mention that there is a draft of non-debt instrument 2021 which was put up in a public domain, wherein a slight modification has been done in that language, where there is a possibility to take an interpretation that if that investment is not a tax avoidance mechanism, probably those kind of investments, even if it amounts to round tripping, could be permitted. However, this is pretty much subject to interpretation. That language was not very much clear, and it is still in a draft stage. RBI has not notified or finalized those regulations. So once it comes, probably there could be some different view which could be possible. This is on the question of round tripping that you have raised. Under an LRS, you cannot make an investment. So, okay, you are allowed to make an investment outside India in an entity, and that entity cannot have a subsidiary or cannot make further investments into any other company. So by that restrictions, anyways, you would not be able to invest through an LRS in an entity outside India, which will in turn have a subsidiary in India. So in my perspective, maybe round tripping could be a secondary question. The requirement of ODI that itself would not permit. Just one thing I would so this is a restriction which is placed under an ODI regulation. I would just mention one more thing here is LRS permits you to acquire securities outside India, whether listed or unlisted. If you are making a portfolio investments are not covered under the overseas direct investment ODI scheme, and therefore even under an LRS, if you are making a portfolio investment into a listed company outside India, till the time your investment doesn't exceed 10% of the capital, it could be regarded as a portfolio investment. And to that extent, you can still make an investment under an LRS to outside India. With regard to portfolio investment, there is no restriction that it cannot have a subsidiary in India. Basically, I'm just making it cannot have a subsidiary or a further investment in other companies. Basically, and therefore, under portfolio investment, those restrictions won't apply. Coming to if it is going to be a portfolio, I believe question of round tripping is unlikely to come up, because if you are a portfolio investment, basically it is not you are not investing money to come bring that back to India. It is pure investment that you are making. In that case, I believe that should not be an issue. That would not be an issue only if it is portfolio investment. If it is ODI, anyways, ODI regulations don't permit it, and there could be an issue on round tripping also. So I think that would be my response to that. What is the reporting requirement for unsecured loan received from non-resident director or shareholder in an Indian company? So, Ghanshyamji, can you whether this unsecured loan which is received, whether it is in a foreign currency loan or and whether the person is from non-resident director or a shareholder, because see, all the loans that you receive, that would be governed by the ECB regulations, and therefore only if you are eligible. So let's say Indian company would be eligible to receive an ECB. So and all loans or trade credits, I would say, so any sort of a borrowing, whatever manner, that would be governed by the ECB or a trade credit regulation, and therefore you would be subjected to whether the person would be treated as an eligible lender itself, whether he's a shareholder, and what is the amount that he would be holding.
Ghanshyam bhai, may I unmute you? 100% holding, sir. He has replied 100% holding.
Achha, okay. So if it is 100% holding, basically, and if it is a foreign currency or an Indian currency borrowing, the same reporting requirement of an ECB would continue, because it is from your 100% shareholder, who is an individual. I understand he is a director as well as shareholder. But a non-resident, basically, in that case, all reporting and the restrictive requirements of ECB would come into picture.
Okay, means with that he has also asked what are the consequences in case of non-reporting of unsecured loans.
So Sure, I'll just. So, in fact, see, it is a violation basically, and you will have to first get a regularization for that, and then once you go for a regularization, RBI is certainly going to ask for a compounding of that basically. So the consequences are as good as you have not reported those ECB. See, in case of an ECB, what happens is you have to actually first get an first file form ECV, you get an LRN. After that, only you can receive money, and post that on a monthly basis. On a monthly basis, you are supposed to file form ECB2. So this would typically amount to non-compliance to all those things. Additionally, there are certain end-use requirements. And plus all-in cost ceiling. If it is an interest-bearing, your interest cannot exceed the all-in cost ceiling. And end-use requirement, if it is used for a working capital or for general corporate borrowing, it has to have a minimum maturity period of 5 years because it is from the direct equity shareholders. It would be 5 years. Otherwise, it could be 10 years basically. So I believe it would start from that whether this loan itself would meet the conditions which are otherwise available for ECB. And the second is, if it is not done, if they are well within it, I believe you should approach RBI for regularization, AD Bank, RBI through AD Bank for regularization of this ECB, and this would call for a compounding. I'm not too sure what is the quantum, but this should be done at the earliest. Next question is from Prashant.
Prashant.
Yeah. I'll just read out. Individual who is now a resident in India and not Indian citizen, that is foreign citizen, but a person of Indian origin. Okay. So person of Indian origin, I can do real estate business in India or can be a partner in firm dealing in real estate business. So see, effectively, okay. So the FEMA typically deals with whether a person is of an, okay. First thing is, if the person is Indian resident, the Indian residency is defined by virtue of your presence and not by virtue of citizenship. So all persons who are resident in India, they are typically FEMA does not really come to a restriction for any activities which is to be done by them, and therefore they can very well do it. The question of person of Indian origin or would come into picture where those persons are actually persons resident outside India. And because they are of person of Indian origin, the legislature they had intended to give some relaxation, and therefore there are few things which foreign citizens cannot do in India, but a person resident outside India, if they are person of Indian origin, they can do it. In this case, because the person is already a resident in India, I assume that he is a resident in India as per the FEMA. So that is the assumption. I think then whatever a person resident in India can do, they are eligible to do, irrespective of whether it is a foreign citizen basically. Question would be, okay. Also, can he repatriate profit out of above he decide to leave India in future, and also can he purchase agriculture? So I think let's put it. Can he purchase agriculture land? I believe more than FEMA, there could be. Because I'm not too sure whether he would be a farmer or he even can even become a farmer or not basically. So I'm not too sure about there is another legislation which would govern that piece as well, apart from only FEMA. Can he take profit out of above outside India? See, if he's a person who is resident in India, if he's a person who is resident in India, in that case he cannot take that money outside. It's an Indian money. Naturally, after he becomes non-resident, then as part of whatever money that is standing to his credit in his NRO account, that on an annual basis in the scheme, remittance of asset scheme, which permits him to repatriate up to $1 million, he can take it outside. But yes, see, the whole try and understand the whole thing, that he's permitted to do those activities because he's resident in India. And not because he's resident outside India. So it's an money earned in India. It has to remain in India. Subsequent, if he becomes non-resident and if he's eligible, he can take that money outside India within those limits which are prescribed for remittance of assets. I think Ghanshyam ji has asked me another question. 100% holding. What if he has transferred from his NRO account? So this is in respect of the earlier query of an unsecured loan. I think fundamentally, what I understand is so whether it is NRE or anything, that ECB see two things. A non-resident, there is a separate mechanism which is prescribed, where a non-resident can provide loan to a relative. And there are again restrictions. So what could be minimum maturity period? I think there is a minimum maturity period of 1 year. Plus it can be given in INR, and it has to be interest-free loan basically. So those kind of restrictions are there, but and it has to be given to a relative. This is a borrowing which is done by a company. Company doesn't get into definition of a relative, and therefore this would still fall into an ECB category. So it would not, in my view, it would not make difference even if it has come from an NRE account. I would probably even believe that what was the declaration where a foreign company has invested in Indian LLP under, where a foreign company has, this is a question from Parag Mehta, where a foreign company has invested in Indian LLP under Schedule 4. Indian LLP under Schedule? It should be Schedule 6, I suppose. Let's read that. On a Indian LLP under Schedule 4 on a non-repatriation basis. Can the profits of the LLP be repatriated outside India? Also, if the profit is accumulated, can it be repatriated in subsequent years? So I think there is some sort of see, typically I would say that if there is the profits are generation of profit and distribution of that is a current account transaction. It is not a capital account transaction. And therefore it should ideally be repatriable outside India, even if the investment which was made is on non-repatriable basis. The only concern that comes with respect to an accumulated profit in an ordinary circumstances, I would have However, Schedule 4, I think at two places it says that it would be treated as a reinvestment. Whatever is the profit which are accumulated, it would be treated as a reinvestment, reinvestment basically, and therefore it actually partakes the character of investment itself. If the original investment was non-repatriable, I think the reinvestment, any subsequent accretion to that would also be treated as non-repatriable, and therefore, with this a clearer understanding, I believe there could be an issue on repatriation in subsequent years. This is not something which is free from doubt. Even earlier, before this regulations, I think if you ask me, I was holding a view that subsequently it could have been done. But with this LLP, I think they've made this clarified at two different places. Let me clarify if I can get that right away. In fact, they have not clarified it here. So in Schedule 6, they have made investment by way of a profit share, which is effectively accumulated earnings, shall fall into the category of reinvestment of earnings, basically, and that's how it would typically be treated as an investment. So if it is non-repatriable, I think that would cause some sort of a difficulty. So ideally, if it is non-repatriable and if you have an intention to take that money out, ideal course would be to take it effectively on a regular basis outside India. But let me ask you a question, because I think you have said that where a foreign company has invested in an Indian LLP under Schedule 4. So I'm slightly confused because Schedule 4 deals with only NRI and OCIs. How would a foreign company would have invested in an Indian LLP on a non-repatriable basis? Because NRI and OCI, they are only permitted to invest on non-repatriable basis, and not the foreign companies. They would generally be investing on they are permitted under Schedule 6 on the repatriable basis only. And if that is the case, the question would not come ideally. Okay, I think there is. Is there a follow-up facts that you can probably share?
Sir, there is a question from Ghanshyam Jalal.
That's a different question. So I was thinking whether if Parag ji has an additional facts to probably so that I can answer that question.
He has given then company owned by NRI or and OCI. That type of situation he has asked.
So, see, even if it is a company owned by NRI or OCI, it is effectively so overseas corporate bodies that have been now de-recognized. So they are treated as good as a foreign company. They are not eligible to invest under Schedule 4. So I believe this is not something which is otherwise permitted.
I think means the question from Parag Mehta is complete, sir.
Okay. Okay. We'll move on to the next question.
Ghanshyam Jalal.
Yeah,
if original shares are allotted on non-repartition basis by Indian company, but now they want to issue share on right basis to same shareholder on repatriation basis,
no.
Is it possible?
No. So if the original investment was made on non-repatriation basis, all subsequent either the bonus issue or the rights issue that would happen only on non-repatriation basis. I can probably give you, because regulation appears to be pretty clear on. I can give you the was resident right, which is was a personal resident. Even when it cannot be made. So I thought, in fact, it is not possible. So it doesn't clearly gives. In fact, the regulation only provides that someone who was originally a resident and now when the rights issues are being done is a non-resident. Even in his case, whatever shares get allotted, it would be on non-repatriable basis only. So it doesn't give you exactly what you are looking at. But then, see, it's a for all practical purpose. Let us understand that shares which are on non-repatriable basis, and they have given this clarification, I think 2 to 3 times different places. It would be treated as good as a domestic investment. They are not treated as a foreign investment only, and therefore any rights which are accruing or arising on that account, it would also be restricted in that sense, and therefore it would be treated as a domestic investment, and rights issue cannot be done on a repatriable basis.
Okay. So there is a question from CA Divyang Panchal.
Yeah.
Whether a person investing in shares in INR have paid in INR for shares of US company has to file ODI form?
Whether a person investing in shares
in INR have paid in INR for shares of US company.
Okay, has to file. So okay, I think there is a follow-up fact also. Let me just read that. Payment for shares of US corporation purchase is made in INR from Indian savings account to NRO account. Capital gain is paid in India, whether it need any Fema compliance or hit by any guideline. So okay, so see, as I said, in an outbound scenario, under an LRS, you are eligible to acquire shares of a company outside India, whether listed or unlisted. If you are making an investment under portfolio investment scheme, in that case, you are not required, and you are not required to file Form ODI. Portfolio investment is investment. Now, ODI regulation, that is outbound investment regulation, they don't define what is portfolio investment. Neither the LRS scheme prescribes what is portfolio investment. And therefore, a reference, if we take it from an FDI regulation as to what is called portfolio investment, in that case, basically is whenever if you are investing into a listed company, and if your holding is less than 10%, that could be regarded as a portfolio investment. Unfortunately, while the master direction does recognize that portfolio investment is not covered by this, it doesn't define what it means, and therefore we are taking an inference from the FDI regulation. So if you have invested in a listed company in US and your holding is less than 10%, it would be treated as portfolio. In that case, you are not supposed to file ODI form. But if you have invested in an unlisted entity, in that case, it is covered by ODI regulations, and therefore you are supposed to file form ODI. Despite the fact that you are making an investment under an LRS scheme only, you are still required to file form ODI, and there are certain additional restrictions or compliance restrictions that are placed under Schedule 5 of that regulation. As I said, that it cannot have a further step down subsidiary, it cannot have a subsidiary, or cannot make further investments. Those kind of restrictions are there, so that also needs to be checked on that front, basically. So I think if it is portfolio, I think you are safe. Otherwise, ODI needs to be done. What I can also mention is, if the investment, so this requirement of filing form ODI was brought in from 2000. Effectively, I would say it was brought under the purview of ODI from 2009. So if any investment was made prior to that, it should be fine. Even government, so RBI had allowed. I don't remember the exact date, but between 2009 to 2013. Even if you had not made filed ODI form, they had condoned and they had considered that as a sufficient compliance. So if the investment is made post 2013, I believe you would need to do a regularization before you receive money. So that is something which is insisted by AD in almost all cases now.
Okay, sir. Next question is from CA Aniket.
Yeah.
That is, RBI NDI rules says that in course of transfer of foreign share, deferred consideration is allowed up to the extent of 25% only. Whether the following is allowed, and in that he has given two situations, that liability arise once payment is deferred, and second situation is payment arise in installment and discharge in installment.
No, so in case of transfer of foreign shares. No, are we referring to non-debt instrument? So non-debt instrument deals with inbound investment. So what I understand, transfer of shares of an Indian company. Is that a correct understanding? I mean, Aniket ji?
Sir, my query is related to deferred consideration. He has clarified that.
Yeah. So okay. So see, basically RBI non-debt instrument regulation, it says that ideally, okay, in respect of a transfer, it permits only deferred consideration only to the extent of 25%. So if the shares are being transferred in tranches, then your installments, which is in sync with tranches, that should be fine. Let's say, but then if you are transferring 1,000 shares right now, 75% of the consideration you have to receive now, and 25% only can be deferred subsequently, which also has a maximum limit of 18 months. So within 18 months, that has to wind. So maximum for an 18 months it can be deferred, not beyond it. In fact, that is with respect to deferred consideration. It in fact even to an extent provide that in case there is an escrow arrangement which has to be agreed, that even in that case maximum up to 25% can only be deposited in escrow, which also has to be wound up in next 18 months. And what also comes up is, what in case your consideration is contingent, or you need to give some sort of an indemnity and therefore you want to keep money pending. In that case also what it says is, if you have paid the full consideration, then maximum up to 25% you can give indemnity, which also has a maximum tenure of 18 months. So I think 75% has to be paid right now, 25% you can keep it contingent, which again cannot go beyond 18 months from the question. Whether can be paid in an installment. So that is not possible. I would say that, okay, if there are 10,000 shares which you have to transfer, you can certainly identify tranche wise that, okay, I am going to transfer them in 10 different tranches. First 1,000 shares are going to be transferred, against which this is the consideration. That way, in case you want to make it an installment, that's fine. But then your compliance requirements would be for qua each tranche, basically. So payment cannot be in installment. You have to make at least 75% payment right now. 25% can be deferred up to 18 months.
The next question is from Amit Kothari. Unlisted companies are not covered under the portfolio investment.
So as per the FDI, which is an inbound investment related, so non-debt instruments typically. It typically says that it is not about, so it is, yes, unlisted companies would certainly be treated as a direct investment. It would never fall as part of a portfolio investment. Even in case of a listed company, only up to 10% would be treated as a portfolio investment. Beyond that, it would be treated as a direct investment. There is no definition which is given under outbound investment, but more or less the same analogy applies there also.
Sir, there is a question from Ghanshyam, CA Ghanshyam, that in case of transfer of share of Indian entity by resident individual shareholder to non-resident entity, within how many days the payment should be received?
So, see, in fact, in this, so I think payment, this should also apply to what we say deferred consideration. Anyways, it is not so deferred consideration should not. I think payment should be received, and for each amount that you receive, there is a separate FCTRS that you would need to file within next 60 days, basically. Even if you receive in tranche, basically. For, I think that deferred consideration does apply to this also. I don't think that there's any differentiation on this. So I think that's exactly was the question. So regulation 9, sub-regulation 6, it says in case of a transfer of equity instrument between a person resident in India and a person resident outside India, an amount not exceeding 25% may be paid by the buyer. So there is no mention that, okay, it has to be received in 2 days, 5 days, or but then I think within initially it can't permit a deferred. So the moment you decide on a deferred installment, it's a deferred consideration. So maximum 25% is what you can defer. 75% has to be received right away.
Okay. So there is a question from CA Parag Mehta. A resident in India has made ODI in USA. Now suppose the individual becomes non-resident, whether the investment made as ODI should be realized or no need to bring the money back to India?
No, so I think if the person was resident who made an outbound investment, if he becomes non-resident, there is no need to liquidate the investment. He can continue to hold the investment. And question is, if he liquidates after going to US, typically he is realizing his asset which is overseas made legitimately when he was resident in India. But whenever he is realizing that money, I think at that point in time, if he has become non-resident, in that case, say because Fema requires only residents to bring all their legitimate dues back to India. So all their legitimate dues back to India, not to non-resident, and therefore he may not need to bring that money back in case he disposes it off. He can continue to hold those shares without any sort of a restriction.
Sir, there is a question from CA Aniket. There is a situation of inheritance of share. Indian shareholders of private limited company dies and his shares go to his son or daughter in example USA. Is there any reporting requirement? And in case there is a requirement of reporting in FC TRS, there is only two options: sale and gift. Which option to select?
So what I understand is the Indian shareholder. So originally it was held by an Indian shareholder, and therefore it was a domestic investment. When as part of an inheritance, it goes to his son or a daughter who is currently resident outside India, and let's say in US. In that case, that investment will be treated as an investment on a non-repatriable basis. So any transaction between the resident or any transfer transaction, whatever, between a non-repatriation and an Indian resident is otherwise not required to be reported. See, FCTRS comes into picture. I'll just mention FCTRS comes into picture wherever the character of the shares undergoes a change. Either it becomes from non-repatriable to repatriable or repatriable to non-repatriable. At that point in time, FCTRS comes into picture. So wherever a resident is transferring it to a non-resident, wherever a resident is transferring to person resident outside India who is going to hold it for on a repatriation basis, or where it is the other way, or in case where there is a person resident outside India who was holding on non-repatriation, sells it to someone who wants to hold it on repatriation, or vice versa. So in this case, FCTRS is not required. I think you can also have a look at RBI FAQ. I think there is one FAQ which very categorically mentions that this will not be required under.
Okay. Sir, there is a question from CA Parag Mehta where HUF has a non-resident co-partioner. Upon partition, the property received by the NRI co-partioner can be repatriated. Is there any restriction?
Where HUF has a non-resident co-partner, upon HUF has
Partition.
the property received by NRI partner can be repatriated. So I think fundamentally whatever property which is received by an NRI, whatever it may be immovable, maybe something else, I believe that is because if it is an HUF and the property which was located in India, those property, so repatriation related concept doesn't apply there. It would become his property, which is typically an Indian property, and any repatriation relating to his Indian assets would be governed by remittance of assets. So you can probably if that needs to be sold effectively, you can credit those amounts to NRO, and within that $1 million limits, you can repatriate those funds.
Okay. Sir, we need to wait for a few minutes. I think all
Sure.
the questions you have already answered, sir. Yes, Aniket, you can, means you want me to unmute you? Yes, the questions from Aniket that there is an Indian private limited company. Foreigner wants to invest in Indian company, that is FDI. Hence, Indian company issue him one share. Yes.
Let him write his question.
I think he is writing, I mean, still typing the question.
Sure.
How to deal with forex difference? For example, received 10,000 rupees for issue of share of 9950.
Aniket, this is very typical. If you have received 10,000 rupees and 99, so I understand. But then ideally you have to receive exact money. If there is any excess that you have received, you have to refund, because otherwise, even for a small amount of 10 rupees, RBI can come and ask you a question as to why you have not refunded, because whatever excess money that you have received, if you don't issue shares against that, within 16 days, 60 days, you have to issue shares within 60 days. If not, in next 15 days, you have to refund the money. Otherwise, you are in violation. I fully understand that you wanted to receive only some particular amount of money, but by virtue of exchange fluctuation, You can ask banker to give only 9950, ask them to charge additional bank commission or whatever it is. But then I believe that would be the ideal scenario for you to probably get through this. I feel this is a practical challenge. If you have received a short money, I believe you will have to get that balanced money. We don't have a real practical answer to it.
What if we received slightly short amount? Do we do
See,
short allotment?
if you do a short allotment, that's not an issue. So far as whatever money that you received, if you have allotted shares against that, did compliance, absolutely fine. Now, whether you will be able to do a fraction, not fraction, I think those things you will have to consider. But otherwise, that just utilize that money fully. That's it.
Once again, sir, I think there is no question. Sir, really appreciate, because from which corner the bullet is going to come, that you don't know. But still you are giving all the answer with so much confidence and with so much means knowledge oriented. So that is too good, sir. Sir, let's wait for 5 minutes. If
Sure.
means for 5 minutes, if there is no question, then we can end this session, sir.
Sure.
So all the participants, please, means if you have any question, then please raise in that 5 minutes. Sir, there is one question.
The term capital market is not defined anywhere. So if a person invests in equity instruments of Indian company, can it be considered? Because in borrowing and lending regulation, there is a restriction. Yes. So under ECB regulations also, if you borrow through a ECB, you can't put it under capital market, which would include an equity investment naturally. So yes, you cannot. Equity market would certainly include capital market would certainly include equity investment. In fact, the borrowing ECB regulation puts it into capital market, and equity investment is anyways already part of it. So if you need to refer that exactly, I can probably do that. So that is something surely you can't put it into an equity. That is surely covered. It covers some additional portion, but not this. So just from the context that you might have picked up is ECB there is a negative list which says investment in capital market, and it also says equity investment. In fact, it restricts in both ways. So listed equity is certainly not permitted. Is FDI from Taiwan is considered as part of China, since FDI from China gets attracted restriction? Surely. So can you unmute Kathy, please? Okay, can you mute Kathy, please?
Arpit sir, this is Parag Mehta.
Yeah,
Yes,
Parag.
Parag, you are now unmuted.
So exactly as you pointed out, that in external commercial borrowings master direction, they have separately given invested in capital market equity investment. But in borrowing and lending regulation, restricted end use is defined. There equity investment is not given, only investment in capital market is given. So can we take a view that investment in capital market is different than investment in equity instruments of an Indian company? And considering that capital market is F&O trading and margin trading.
No, capital market. So okay, capital market would include. So typically, if you have to still distinguish, I would still put it. Capital market would not only include only equity. It would rather include anything which is a public trading platform, basically, which would include even including derivatives, including equity, which is sort of a listed. So that's a capital market. A normal understanding of capital market would be, it would not only be equity. The distinction would still be, yes, the listed company's shares would be part of capital market, unlisted would be a pure play equity basically. So that could still be a distinction in case that is making a difference on your context.
Okay. Sir, there is a question from CA Aniket, that is FDI from Taiwan is considered as a part of China, since
So
FDI from China gets attracted restriction?
So okay, I'll answer this. See, after April 2020 notification, there is no formal announcement that is being made. But then I think we have worked with Invest India a couple of times, and I think for this purpose, Taiwan is not considered as part of China. Hong Kong is considered as part of China because it is governed and ruled typically by China. Taiwan is they claim themselves to be a separate sovereign state, while India does not recognize that. It still does not consider it as part of China. And I can tell you that we have got companies incorporated from Taiwan in last 2 years. So that is this is an accepted item. Just one thing, because what happens is in respect of China, the confusion still prevails as to who. So in case of investment which is being made by funds or PE investors, there could be number of investors, and therefore whether there is any threshold of Chinese investment. Very unfortunately, I would say that there is no threshold which is given. So either the company is from bordering states, or if the ultimate beneficial owner, even if he owns one share, very theoretically I'm saying, technically the law gets attracted, and they cannot make investment unless and until there is an approval which is taken from DPIIT. What has happened is there are about 350 plus applications have been made. Government has internally said that go slow, and to my understanding, I think they have not cleared any of the applications. But when it comes to banks, I think what we have observed is when the investment is via some PE funds or some other funds, then they actually take a declaration that the Chinese investment, that there is not more than 10% or 20% of Chinese investment, depending on the tolerance limit of the banks. See, at times what happens is those funds don't have real clarity as to who really or what is the quantum of Chinese investment, or who really owns them. So a few banks have taken a practical call. Law still says the same. In fact, there were 3 months back, there were certain news articles which were doing some rounds which said that RBI has more or less agreed that either 5% or 10% threshold should be provided for the Chinese investment in the entity which is making an investment. But that still remains as part of news. There is no formal notification as yet. So it still remains, even one share is difficult. One second, I'll just switch on the lights. Yes. So
Sir,
if
there is a question from CA Vijay Sheen.
Yeah, I'll read it. If a resident Indian along with Indian party has invested in overseas JV, which has further invested in pharma company, now bank says, as there is RI member in overseas JV, you cannot make investment in step down subsidiary. As a matter of fact, yes, because he would have done it under an LRS scheme. So can the investor sell investment in step down subsidiary and bring back money to India? Step down subsidiary or that first subsidiary? So can the investors sell investment in step down subsidiary and bring back money to India voluntary? Very technically, that so step down subsidiary was not permitted. If you have already done it, anyways, so it's a fait accompli. You will have to go through that process. Ideally, the AD banker would ask you that has to be disinvested, and even still, compounding would probably be required to be done. bring back money to India voluntarily, that okay, and file disinvestment form for voluntary winding up of overseas JV. So those things are fine. See, it's like if there is a violation, whether that violation needs regularization. Yes, it needs regularization. Uh, See, I think in my view there are two things. You can certainly disinvest that SDS, or probably what you can also do is, if that resident Indian investor he sells off shares to the Indian party, and therefore it becomes effect, if that is possible on other consideration. Your violation with regard to Indian investing into an entity which further sets up an SDS, that still remains. But I believe that you can regularize, if it is making a business sense, you may continue your investments. If you feel that from a business perspective itself you want to wind it up, fair enough, you wind it up and file a disinvestment. The contravention still remains. You might still need to do a regularization for that. So question, or they need to report the contravention to RBI first and go for compounding first. What will happen is, generally if there is a contravention which is figured out, they will ask for regularization of that and compounding before taking further actions on those overseas investments. So that's the general tendency, that because see, what happens is, once you file a disinvestment, then typically that UIN goes off that track basically, and therefore any action which would put UIN off the track, that they will not undertake. They will first ask for regular. In any case, filing for a disinvestment, even RBI before approving it, it would check everything, including whatever your past actions are, including filing of APR, and they will once they are sure, then only they are going to accept that disinvestment. So even if you file, I think it will not be approved. All back processes will have to be completed. If any remittance is received towards shareholding through transfer wise PayPal, are those acceptable by RBI? So I honestly I have been holding a view that I think PayPal and transfer wise, I'm not too sure whether they are authorized dealers. I think for a client couple of years back, when we had checked, they were not willing to issue FIRCs. They were receiving money through a different mode. Therefore, it was advised that this would not be an ideal mechanism to. I am not aware of TransferWise. PayPal is what we checked up. Very recently, I think for a different client, when we tried to check, I think PayPal now said that there is a mechanism whereby they would be issuing FIRC, including necessary documentation that is needed for you to prove and justify. We have not yet entered into that transaction, so I'm not too sure. But then that is what now you can check, if they can issue FIRC and other documents, because once you receive foreign investment via that, I think there are certain additional documentation that needs to be received, including KYC and all those things. I think whether that would be available. If that is the case, I think it should be good enough. Otherwise, I would suggest to avoid it. Let it be a normal banking channel. PayPal should ideally not be used. In fact, there are some sort of an issue when it comes to even receiving money against the exports also. So, if possible, avoid it. Rather, I would not recommend it.
Right. Okay. There's another. Okay. So, anyone want me to unmute them? Parag Mehta, you want me to unmute you? Do you have another question then? Yeah, just one. Parag Mehta wants to ask the question. Just one. Just unmute him. Yes, Parag Mehta, you can ask it.
That this is in relation to my previous question on whether on HCF partition that NRI co-partner can remit assets out of India. So there was a question that on partition, is NRI eligible to get the assets, the property, maybe shares or immovable property?
So Parag bhai, I think this is something which is a question which somehow is doing around. So this is not only with respect to HUF, but even in respect of trust. So whether a non-resident beneficiary in a trust, whether when they created an interest, whether that itself is something which is correct. There have been different views on that. There is one view which says that when the interest was created, finally whether they are going to get anything out of it or not was not sure, and therefore it may not be amount to a capital account transaction. There is another view which says that ultimately you might get something, even a right to receive something in future itself is a capital account transaction, and therefore ideally this should be done with an RBI approval. Even in case of trust, this is something which is very uncertain. RBI is well aware of this situation, and somehow it is not clarifying it openly. They are keeping it pretty open. So in this case, I would say that there are different views, and therefore I said that even if NRI receives it, I think, see, because it was a question of NRI, it was not person resident outside India. If it is NRI, it can certainly have certain domestic investments, and they are eligible to hold their assets, which typically in this scenario, I would say that HUF partition, I would still, so trust as a larger issue. In case of an HUF partition, I would still put it that this is while typically this is not an inheritance case, this is out of their family property, they have got a share out of it, which I would still put it as a upon partition, it could still be regarded as an asset received as part of inheritance, which they would have to continue in India, and as part of remittance of assets, they can liquidate those assets and probably take it back within those limits. So that's why I said I gave a view, a perspective that would probably not put you in sort of a difficulty.
Okay, thank you.
Right, sir. We can also have a few questions. If any participants want to ask, I can unmute him or her. Just drop a message in the chat box and I'll do that. If, anyone can write also the question. They're not able to use their mic right now. Better. Meanwhile, we can also, throughout this process, many questions have been asked today till now. So we can also have your some additional comments or additional scenario if you wish to share. There is another, also we have another question from Mr. Anik.
The company has foreign shareholders face value per share ₹100. Now company has made a stock split, for example, 5 to 200 is reporting required, not required. So stock split, it doesn't change anything. No reporting required on that count. No, I think you were mentioning, but I think good number of points they've cleared. I think practically I would say that what one should there are a couple of things which I believe gets missed in this. One is downstream investment is something which I have generally found that people are generally not aware. So if there is an Indian company in which there is a foreign investment, and that company is not owned and controlled by Indians. So if it is 100% subsidiary, naturally it is owned by 100% subsidiary outside India. So it should have more than 50% should be owned by Indian resident, and more than 50% of majority of the board of directors can be appointed by the Indian. In that case only it would be treated as typically an Indian company owned and controlled by Indian resident citizens. If that is the case, downstream investment doesn't apply. But otherwise, let's assume that there is a foreign company who has set up a wholly owned subsidiary in India, just for an easier reference, I would say, or there is a joint venture where the foreign company holds more than 50%. That's an easier reference, I'm saying. If it makes any investment in any other company in India, then typically that would be treated as a downstream investment. And therefore that would have an equal amount of so it's an indirect foreign investment, and therefore it requires a reporting dual reporting, one to DPI, so SIA, Secretary of Industrial Assistance, also whenever you decide that investment is to be made, plus there is form DI which needs to be filed by the Indian company which actually has that foreign investment. So this is something sometimes overlooked, because the Indian company, which is the second company, they receive money only from an Indian company, and therefore they don't treat it as a foreign investment. This is it is sometimes missed. So I think this is what I thought people should probably bear in mind. Another thing, I think 2-3 things. So foreign investment in an LLP is permitted, but it is permitted only in cases or in sectors where 100% FDI is permitted, and there are no FDI linked performance conditions which are prescribed. I think by and large, if you ask me, more or less, all these sectors effectively goes out. So LLP can do. So I think effectively manufacturing and the services which are not covered by that table, that broadly gets covered, because more or less all the sectors which typically we look at. I think there are a couple of sectors where there are still no condition, but then so the manufacturing and some of the services, I think they would only be available to the LLP. At times, I must say that, let's say that is a foreign company who wants to set up an entity in India for an wholesale distribution. So that is not permitted under an LLP, because there are conditions which are attached to wholesale distribution. Retail anyway is not permitted, but even in wholesale, so B2B sales, let's say if a company from Germany, they wants to have their sole selling distributor in India through their LLP, it would not be permissible. This is at times gets missed because generally LLP is now permitted, so and therefore this is taken care. If the Indian LLP is acting as a commission agent, they can still do it, but not as a distributor on a B2B basis.
Right. So I have okay. Let's Parag bhai want to ask one question regarding downstream. So I guess Parag bhai, I'll just mute you. Yes, Parag bhai, you can ask.
Hi, sir. So in downstream investment, there is an explanation that an investment made by NRIs on non-repatriation basis, it will not be considered as indirect foreign investment. So is that explanation applicable to OCIs also? Because OCIs are not included here.
Okay, I'll have to look at that explanation, but then ideally, see, in fact, so any investment which is made, so investment made by NRI on non-repatriation basis is treated as a domestic investment only, and therefore, so the first criteria or the first condition which it has a foreign investment, that itself would not be met so let me read the definition of indirect foreign investment. Okay. Rule 21. No, I see. No. Definition is where is it? Where did I read that? Oh, yes, here. So it says indirect foreign investment. Sorry. Indirect foreign investment means downstream investment received by an Indian entity from from another Indian entity. Now it says downstream investment. So downstream investment shall be an investment made by Indian entity which has total foreign investment in it. So now if we refer investment which is made by NRI and OCI, which is under part schedule 4, which is on non-repatriable basis, there is an explanation. So schedule 4, it says purchase or sale of equity instrument, convertible notes, or contribution to LL capital or LLP. And in that it says investment detailed in subparagraph A, paragraph 1 above shall be deemed to be a domestic investment at par with the investment made by the resident. So schedule 4 investment would be treated as a domestic investment. So NRI as well as OCI, it would be treated as a domestic investment. Therefore, downstream investment related provision should not apply to that also.
Okay, sir. Thank you.
Hello.
Yeah, Hardik.
Yeah, sir. Okay. So,
Sir, there is no more question, I think. Once again, we are in the same situation. Let's wait for 2-3 minutes. I request all the participants, if you have any query, then please raise it immediately.
I'll take one opportunity to ask one doubt. Actually, many of my friends who are related to this IT field, they are really concerned about how they should go for cryptocurrency transactions now going further. So what you suggest, sir? Because they are in day in day out now, people are asking, and even now TDS provision, income tax provision have come in. So what are your views, sir? How to go further with crypto in view of Fema?
So I think see what has happened is something is very interesting. The government neither says it is legal nor says it is illegal, or rather says that we have never said that it is illegal. At the same point in time, they are not even willing to recognize it fully. I think some time back so I think more or less anyone who deals with them, I think so RBI had given some sort of a circular. I don't exactly remember the wording, but if a layman reads it, more or less the meaning was that this is something which is not permitted. Arpit bhai, mute karenge? So more or less all the banks, they probably sent a circular and email to all their cryptocurrency holders that this is what RBI said. Very funnily, I think about 2 months back, somehow RBI probably sent another circular to banks and said, we have never said that this is not. The language was little different, but the tone was that it is not permitted. ऐसा हमने कुछ बोला नहीं है. It is something different basically. So we have never said that it is illegal. It is so. What is real frame? We don't see. Unfortunately, today we don't have a framework, and therefore we are not able to decide what is right and what is not. Income tax, bringing that into a statute book under the Income Tax Act does not make it legal. First thing. At the same point in time, like RBI का जो circular आता है, उससे you are not very sure whether it is really legal or really illegal. Either ways, I would say. I would put it this way: is see, the moment you are trying to tax something does not necessarily mean like gambling and betting is taxable in India, but not necessarily permitted under all situations basically. So it is exactly same kind of. See, in fact, if the government is probably wanting to legalize it officially, I would put it right now also it could be, and I think as we all are aware, there are so many people who are already invested into it. So it's not a question that it is not happening already. So in case they want to formally legalize it or probably formally bring some sort of a regulation around it, beforehand they have sought to tax that. So as and when that framework comes in, they don't need to change tax law. Tax law is already in place, and you start taxing them. Basically, I would put it in that perspective. There were rumors which were doing rounds that even GST would be levied on that. There are a few other things which are doing rounds. So somehow with that 30% thing, what it appears is government wants to discourage them. Probably they still want to go with digital rupee, but wants to discourage all other types of crypto. My view, I think if you ask me legality, I have no clarity about the legality aspect of it. What could be in government's mind? See, everyone is looking at it's a speculative item. It may go up, it may go down, it may go sharply up. I have no idea. The reason, I'll simply say the reason of crypto and probably now multiple cryptos. The original reason for coming out with Bitcoin was argued, and because I had attended one of the session, I don't know much about crypto. Since you have asked me a question, I'm responding based on whatever limited understanding that I have. But it was argued that today the central banks, they are probably deciding as to which currency should be probably get what sort of weightage, and probably we are trying to get freedom from what government decides. My thought process is slightly different, and I would believe that so far as we want to remain as part of a nation, as part of a democracy, I think we will have to allow them to probably to an extent regulate us. Otherwise there would be a chaos. So as an investment, one can certainly look at it. I don't mind, but then I believe that the moment government feels that this is going beyond what they anticipated, there are bound to be restrictions and regulations which are likely to.
Right. Thank you for the clarity.
That's absolutely my personal opinion with a limited knowledge of crypto, and therefore please pardon me if someone is hurt.
This clarity is much more than what we knew till now. Thank you.
Okay, so there is a question from C. Aniket, that is transfer of share is done requiring TRS. TRS filed in time, then later on TRS got rejected for whatever reason. Now if TRS is filed, will it be violation and late fees will be attracted or not?
So if it is rejected, it is as good as it is not filed. It would have LSF would certainly be attracted. See, these are automatic things, and probably you don't have even chance to really disprove those things. Unfortunately, without late fees, it would not even get submitted. Unfortunately, so that's a fait accompli again.
Yes. So
American person comes to India for job in Indian company located in India. Now ESOP is issued to him. Is it issue of shares to resident or a non-resident? If he's come to India for the purpose of job, it is issue of shares to resident, not a non-resident. It would be treated as a resident.
Okay. GPR not required then.
No, and it would be treated as a domestic investment. So he cannot repatriate that money under normal scenario. Once he liquidates it, he will have to credit to NRO, and then within that limit he will take it back. So it is treated as a domestic investment.
Sir, it is already 6:59. So can we conclude this, sir?
I think so. If there are no questions, we can conclude.
Yes.
Okay.
Okay, sir. Let's conclude this. Sir, thank you so much. As I have said you earlier, that truly means amazing lecture, because from which corner the bullet is going to come, that you don't know. And in that case, the means ODI and all these are very difficult subject, and you have answer all the questions on the spot. So that is too good. And as said earlier by Hardik, that we can write one small book also on all the means all the qualifications you have and all the experience and all the means the truly expert views we have received, and even chat box we have received so many good remarks from all the members also, sir. And as it is a closer lecture of FEMA series, so this type of knowledge sharing is required, and you have done the tremendous job. So thank you very much.
My pleasure. My pleasure.
Yes, sir. Thank you so much for your
Thank you.
time and for your knowledge sharing, sir. Thank you so much.
Thank
And
you.
with
Thank you,
that,
everyone.
we also thanks all the participants and all the members who have participated in this series and in today's lectures also. Thank you so much, sir. Thank you so much.
Thank you. Bye bye.